Hi, welcome back. Today I'm going to talk about one of my least favorite topics. And by the end of the session, you're going to see very quickly why I call it one of my least favorite topics. It's about the Fed. It's not just about the Fed, it's about central banking in general and how, over the course of the last 20 years in particular, we have acquired a whole set of delusions about central banks that are actually getting in the way of good investing. Now, what triggered this? 2 days ago, on September 18th, the deed was done. The big action we've been talking about for much of the last year was taken. What am I talking about? The Fed on September 18th finally got around to cutting interest rates, and we'll put quotes around it, by more than expected. Now, the initial reaction markets had was a little anemic. Stocks didn't do much. But this action has been debated and discussed more than any other single action during all of 2024. The initial market reaction, as I said, was anemic. Yesterday, Thursday, the day after, stocks were up strongly. Today, they're down again. And by the end of the week, I'm sure people will be pointing to everything in the market as due to the Fed action. I'm a long-term skeptic about central banking power. And I thought this is as good a time as any to talk about the delusions that I think get in the way of understanding interest rates and central banks. There are four broad myths that I see, and these myths are in the order of delusion, from the most fantastic to the least fantastic. And I want to take each of them and confront them with data. The first is that the Fed sets interest rates. So in this mythology, the Fed sets the interest rates that you and I, as consumers and businesses, run into in our day-to-day affairs. The second, slightly less mythological than the first one, is the Fed doesn't set rates, but the rates it sets leads the rest of the market in setting interest rates. The Fed is a leader. The third story, a little less fantastic, is that the Fed doesn't set interest rates, but it sends signals to the market, signals about the economy that the market then incorporates and reflects in stock prices and bond prices. And there's a final piece of mythology that the Fed is some kind of a stock market whisperer. That what the Fed whispers with its rate changes is what drives the future of stock prices. Let's start with the first one, that the Fed somehow sets interest rates. This is absolute mythology because there's only one interest rate that the Fed sets. But this mythology is deeply held. In fact, on Wednesday, right after the Fed cut was announced, I was driving to the grocery store and I was listening to the news at the top of the hour. And they talked about how interest rates had been cut. And the message they left was, hey, homeowners, your mortgage rates are going to go down. Credit card holders, your credit card rates are going to go down. Businesses, your bank loan rates are going to go down. That somehow magically, over the course of a few minutes that day, interest rates had declined. But it's not just the newscasters, right? This is, I saw a Wall Street Journal article. I saw a couple of major economists claim that rates had been cut by the Fed. That's nonsensical, and here's why. There's only one interest rate that the Fed sets. It's called the Fed funds rate. Have you ever borrowed at the Fed funds rate? Maybe lent at the Fed funds rate? I'll wager that none of us will ever encounter the Fed funds rate in the course of our lives. And you're going to see in a minute why. The Fed doesn't set any of the other rates that we run into on a day-to-day basis. As consumers, it doesn't set your mortgage rates. It doesn't set your credit card rates. It doesn't set the fixed deposit rates you might face at banks. As businesses, it doesn't affect your bank loan rate. And none of those rates are actually indexed to the Fed funds rate. So let's start at the top. What exactly is the Fed funds rate? It's an overnight intra-bank borrowing rate. It's a rate at which banks lend and borrow from each other overnight. No wonder you and I will never run into it. You're not a bank. I'm not a bank. It's a rate that is not a rate that we deal with on a day-to-day basis. Now, who sets that rate? There's a Federal Open Market Committee. It meets 8 times a year. And at those meetings, and these are the meetings where markets come to a standstill, the Open Market Committee, the FOMC, decides what to do with the Fed funds rate. Sometimes it changes it, sometimes it leaves it unchanged. Once in a while, the Federal Open Market Committee will call an emergency meeting, usually in the context of a crisis. It happened after 9/11 in 2001, during the market crisis in 2008, during COVID in 2020. And usually those emergency meetings lead to a rate change. So let's look at the history of Fed action and inaction on the Fed funds rate going back to the 1980s. During the 1980s, with the Volcker-led Fed, the Fed didn't focus on the Fed funds rate. It focused on money supply. And I came into market in the 1980s. I don't remember a single time thinking about what's the Fed funds rate going to be. That shifted in the 1990s. Alan Greenspan became the chairman of the Fed. The Fed became much more activist in terms of Fed funds rate. There were 33 changes during the decade, 19 decreases, 14 increases. Most of the changes were 25 basis points or 0.25%, 7 were 0.5%, and there was 1.75 basis point change, an increase in November of 1994. In the next decade, especially before September of 2008, this process continued. Greenspan was in charge, the chair, until 2006. Ben Bernanke took over from him. There were 37 rate changes between 2001 and September 2008. 22 were cuts in the rates, 15 were increases. Again, most of those rate changes were 25 basis points, 13 were 0.5%, 2 were 0.75%. Then September 2008 hit. Ben Bernanke was in charge. We were in a full-time crisis. But if you look at 2008 through 2021, the Fed embarked on a policy of pushing the Fed funds rate close to zero for much of that period. In the middle of the period, rates went back up again. For much of the period, rates dropped close to 0%. Some of it was triggered by the crisis. The 2008 crisis caused the Fed funds rate to drop to 0% again in 2020. But for much of that period, Fed funds rate were at historic lows. Then came 2022, and the Fed went into hyperspeed. There were 11 rate increases between 2022 and 2023. 5 were 25 basis points, 2 of 0.5%, and 4 of 0.75% each. Then we were in hibernation for much of 2024, and the Fed funds rate was cut by 0.5%. Now, one way to see the movements of the Fed funds rate over time is to look at what's called the effective Fed funds rate. The Fed funds rate is actually a range. So when it says the Fed funds rate is 2%, it's really between 2 and 2.25%. The effective Fed funds rate shows you where in that range the rate falls. So this shows you what Fed funds rates have done over much of the last 70 years. Notice again, the late 1970s or 80s, the Fed funds rate rose above 20% briefly. It stayed high through much of the 1980s. For Paul Volcker, inflation was the deadly danger, and everything about the central bank was about fighting inflation. Then you get, especially since 2008, you can see what I mean by Fed funds rates dropping low and staying low for much of that period. So when rates started rising in 2022, markets were shell-shocked. They weren't used to a rate-raising Fed. They'd become used to a Fed that kept rates close to 0%. And it did freak people out. So as you look at the Fed funds rate, the question is, what are other interest rates doing? I'm going to divide all other interest rates you're going to face in the market into two groups. One are rates set by the market. US Treasury rates, 2-year, 6, 3-month, 10-year, 30-year, 15-year. There is no entity that sets those rates, demand and supply, bond buyers and bond sellers setting rates. Corporate bond rates, every ratings class set by demand and supply. I focused on three examples of market set rates: the 3-month T-bill rate, the 10-year T-bond rate, and the BAA corporate bond rate, which is a longer term corporate borrowing rate. And you can see that first, market rates they're more volatile than the Fed funds rate because they can change on a day-to-day basis. But clearly there's something driving these rates. You're saying that something could be the Fed. It could be. We'll come back and see if it is. But they're market set rates. There are also what I call institutionally set rates. When you look at your credit card agreement, there is an interest rate in there. Who sets it? The bank that issued the credit card to you. When you go to take a mortgage, you see a mortgage rate. That mortgage rate is set by somebody, a mortgage lender. Again, you might say the Fed drives that, maybe, maybe not. You got 15-year rates, 30-year rates. I've also brought in fixed deposit rates. Remember, as consumers, rates are not just what we face when we borrow, they're also what we face when we invest. You walk into a bank, you put your money in a fixed deposit. It's a fixed deposit rate. It's not a day-to-day market set rate, but clearly it moves over time. Most of the rates, in fact, let me take the most out. All of the rates we run into as consumers and businesses fall into one of these two buckets. It's either a market set rate or an institution set rate. None of them is set by the Fed, and none of these rates that you and I face are indexed to the Fed funds rate. So let's set that myth to the side. The Fed doesn't set any of the interest rates that any of us care about. But saying, but what if the Fed drives rate? It's a leader. So in this story, here's what happens. When the Fed raises the Fed funds rate, the rest of the market wakes up. Market-based rates go up, institutional rates go down. That's behind the newscaster story on Wednesday, where she said if the Fed lowered rates and implicitly extended from that, your mortgage rates are going to go down, your credit card rates are going to go down, fixed deposit rates are going to go down. In this world, the Fed is a superior being with better data, better skills. So when it sets rates, the rest of the world notices. Now, I'll give you the superficial evidence for this. In this graph, I've graphed out not just the Fed funds rate, but all of the market rates we talked about, and all of the consumer rates except for the credit card interest rate, which is a being to its own. And we'll talk about a few minutes about it later. But they all look like they move together, right? So if you were telling a story about the Fed as a leader, you'd look at this graph and say all of these rates are moving and they're all being driven by the Fed. But to truly test whether the Fed is a leader, my suggestion is you try a different test. If the Fed leads other interest rates, here's what you should see. When the Fed funds rate increases in a quarter, you should see other interest rates rise in subsequent periods. Treasury rates, corporate bond rates, even mortgage rates. Let's see if that proposition holds out. So here's what I started with. I went all the way back to 1962 and collected the data for the 249 quarters of data I have through the second quarter of 2024. I broke these quarters down based on what the effective Fed funds rate did during the quarter. There were 96 quarters during this period where the effective Fed funds rate went up. There were 132 quarters where it went down and 21 quarters where it did nothing. Then I looked at what happened to Treasury rates, both 3-month and 10-year Treasury rates in the quarter following. Remember that in the Fed as leader story, when Fed funds rates go up, the Treasury rates should go up in subsequent periods. But that's not what you see here, right? In fact, if you look at the quarters where the Fed funds rate goes up, and you look at the subsequent quarter, both the 3-month and the 10-year rate are more likely to decline than go up in the following quarter. When you look at the periods where the Fed funds rate goes down and you look at the subsequent quarter, what you see is you're more likely to see the 3-month T-bill rate and the 10-year T-bond rate go up in the subsequent period. In case you think I'm cherry picking, you can try this with 2-year, 15-year, 30-year, across the board. You see this phenomenon play out. Put simply, the Fed doesn't seem to be a leader of market rates. You're saying, what about mortgage rates and fixed deposit rates? Well, if you look at the evidence here, I have fewer quarters of data because I don't have the mortgage rate data going back as far. 45 quarters where the Fed funds rate went up. In the subsequent quarter, the mortgage rate actually declined by more than it did in the quarters where the Fed funds rate went down. Put simply, there is little or no evidence that interest rates of any type, market set or other, change in response to the Fed funds rate. So if you have an argument for a market leader, it's not holding up. Now, of course, at this point you're saying, but the Fed did set interest rates. And the evidence that you often can point to is, hey, what else can explain the fact that interest rates stayed at historic lows over the last decade, between 2011 and 2020? So I'm going to pull out a graph that I've used multiple times before, but I find effective in countering this argument. In this graph, the black line is the 10-year T-bond rate each year. The red column is the inflation rate each year, and the green column is the real GDP growth this year. You're saying, what are you trying to do? If you step back from the Fed delusion, here's what drives interest rates. The first is expected inflation. As expected inflation goes up, interest rates should go up. Why? Because as a bond buyer, you've got to cover that expected inflation. The second is what's called a real interest rate, but that's a reflection of the health of the real economy. If the economy is growing strongly, real interest rates will be high, and if it's not growing well, it'll be low. So what I'm actually computing here is what I call an intrinsic risk-free rate. I take the inflation rate each year, I add the real GDP growth to it. So if your inflation rate is 5%, your real GDP growth is 2%, 5 plus 2 is 7, that's an intrinsic risk-free rate. Now, I don't want to hit you again with statistics or statistical metrics, but take a look at the T-bond rate and the intrinsic risk-free rate. And without even pulling on statistical metrics, do the two look like they move together? Why were interest rates high in the 70s? Not because the Fed didn't do its job, but because inflation was high and real GDP growth was on top of that. Why were rates low in the last decade? I'm afraid the answer is surprisingly prosaic. Inflation stayed low. It was the lowest inflation decade in a century, 1.7% on average over the 10-year period, and real economic growth was anemic. Low plus low is low. Why did rates go up in 2022? Not because the Fed raised rates, but because inflation shot up. The culprits driving interest rates are real, inflation and real GDP growth, and this graph basically brings home the point. I know, the Fed can influence rates at the margin, but the key word is at the margin. So the Fed doesn't set rates, it doesn't lead rates. There's a third story said about the Fed, that it's a signal. It's a signaler. What does it signal? The superior information and data that it has. So let's start with the reality that the Fed, and through its 12 regional districts, collects data about the economy and about what's happening in it. And that data is an input into its decision making. So when it raises or lowers the Fed funds rate, it's basing it as a committee on the data that it's looking at. So there is a reasonable basis for the Fed signaling what it knows, right? There's one problem though. There are two major dimensions of the economy that the Fed tracks. The first is inflation. The second is how well the economy is doing in terms of real economic growth. And the two might pull in different directions in terms of a signal. You see, what are you talking about? Let's take the 50 basis point drop in the Fed funds rate that happened on Wednesday. Now, I heard a few people say, this is really good news, but is it? I'll tell you that if you're an optimist when you look at this rate drop, here's how you'd read it. That the Fed is seeing a lot less inflation than there was a year ago, 2 years ago, that it's conquered inflation, and the fact that it's lowering the Fed funds rate by 50 basis points means a war against inflation is done. That's a good news read here. But there is a potential bad news read, right? That the Fed is seeing data on the real economy, and it's seeing a slowdown that's much greater than what we're seeing in the public data. That what you're seeing here is an adjustment by the Fed to the fact that the economy is slowing down much faster. That's a bad news read. And there's a third read. We're less than 50 days from an election. And the third read is this has nothing to do with inflation or the real economy. It's more political than economic, in which case there's really no news in there other than which direction of the political spectrum you fall on in terms of looking at this action. So put simply, you can tell me a signaling story that's a good news story, a bad news story, or a no news story with the Fed, and that is always the problem with trying to read Fed smoke signals. So the Fed doesn't set rates, it does not even lead rates, its signals are very murky. There is a fourth mythology about the Fed, that the Fed is in fact as a big driver of what happens to stocks. And Wall Street feeds into it, right? There's a Wall Street mantra, don't fight the Fed. I'm not even sure what that means. But there's a whole set of investing mantras where you're told that the Fed should be a big factor in your timing decisions of when to buy stocks, when to sell them. Again, I'm not saying there's no basis for this argument, and especially during market crisis, I can see the Fed's role. I mean, I've written extensively in real time about the COVID crisis playing out in markets. And during 2020, I complimented the Fed for playing its cards right because I think the Fed had a major role in stopping the bleeding that was occurring in markets in late March. And part of it was you're saying the 100 basis point or 1% drop in the Fed funds rate. But the real action the Fed took that turned the tide was it stepped in as backing for companies that were on the verge of getting pushed into bankruptcy. Lenders were panicked. And if you remember, Boeing was on the verge of bankruptcy. The Fed actions, and it really never had to put in much capital to back them up, help turn the tide. So I'm going to accept the fact that during crises, the Fed can make a big difference. But the rest of the time, does the Fed funds rate really matter? I did exactly the same thing I did with interest rates. I broke down the data into quarters. I looked at whether the Fed funds rate increased, decreased, or had no change. And then I looked at what stock return the S&P 500 did in the following quarter. Again, remember, the Fed is a market whisperer. When the Fed funds rate decreases, you should expect to see the market go up more in the next quarter, right? Well, and at least in direction, you're getting that. But look at the difference, 2.85% increase in the quarters after a Fed funds rate increase and 3.07% increase after quarters where the Fed funds rate decrease. That's 22 basis points. And in fact, the best quarters of all for the market are the quarters where the Fed funds rate didn't change at all, 5.5% increase. You know how I read this table? Maybe the Fed should act less, talk less. The more the Fed is on the sidelines, the healthier the stock market becomes. There is little or no evidence of the Fed being some kind of a stock market whisperer. So at this stage, you're probably saying the Fed doesn't set rates, it doesn't lead rates, it's not a market whisperer, it doesn't even signal very well. So what exactly does the Fed do? I'm going to digress here and tell you a story. Story of a rooster named Chanticleer. It's an ancient, French fable maybe. The name suggests it's a French fable. And Chanticleer was the ruler of the farmyard that he lived in. You know what gave him his reputation? The rest of the barnyard animals in that farmyard thought that the sun came up because Chanticleer crowed. And you can see why, right? If you were doing a data analysis, they were doing what I showed you with interest rates. They were looking, sun coming up, Chanticleer crows. And because the sun seemed to come up at the time Chanticleer crowed, they made a cause-effect linkage there. The sun is coming up because Chanticleer crows. Now this story takes a dark turn now. One morning, Chanticleer sleeps in. What happened? Maybe his iPhone's alarm did not work. He didn't wake up. And the sun came up anyway. And the rest of the barnyard animals said, why are we worshipping this rooster? The sun's going to come up anyway. This rooster's doing nothing. In many ways, the Fed is like Chanticleer. Before the dark side sets, it drives this delusion that its movements are what drive interest rates and stock prices. And as long as you don't crack the bubble, you can believe that, right? They seem synchronized. But as with Chanticleer, there is a potential for a dark side. If the Fed starts buying its own mythology about setting rates and driving stock prices, and it forgets about the fact that it's just an onlooker, bad things can happen. The power of the Fed comes from the perception that it has power. And if you're a Fed chair or any central banking chair, your job is to preserve that illusion. Which leaves me with my conclusion. As I said at the start of this session, I'm tired of the Fed effect. I'm tired about people talking about the Fed. Why? Because I think that the Fed delusion has been deeply held, and especially so for the last 2 decades. And it's very convenient for a lot of people. In what way? Active investors have come off perhaps their worst decade in history in terms of underperformance relative to indices and in terms of losing market share to passive investing, index funds and ETFs. And if you ask active investors what happened, and you can pick any subset you want, value investors, growth investors, you know what the most common excuse they give is? The Fed did it. It's the Fed's fault. Market timers for 15 years have been using their Schiller P's and variance to tell us stocks are overpriced and to get out of stocks. One of these days they might be right, but if you'd listened to them over the last 15 years, you sat in the sidelines of one of the great bull markets of all time. You ask them, why are your metrics not working? You know what the answer is? The Fed did it. How many times have you heard the claim, and I've heard this multiple times from economists, that an inverted yield curve is a surefire predictor of recessions? We've had one of the longest stretches of inverted yield curves in history, and there's been no recession. Just what happened? The Fed did it. How convenient. I think it's time to let go of the Fed delusion. It's been a distraction that gets in the way of us talking about the real problems we face. A federal debt that keeps growing and growing, inflation, growth, globalization, increasing risk. Those are real issues. But we're so caught up in what the Fed has done, what the Fed will do, what the Fed might do, that we're losing track of what we should be tracking. All that said, though, there are a lot of people who live on this delusion. There's a whole group of people whose jobs, I think, are built around watching the Fed. They're not going to go away. In fact, I'm already hearing talk of what the Fed might do at its next meeting and the meeting after that, and why that will drive what markets do for the rest of the year. What absolute nonsense. I know you might not share my views of the Fed, but I'd like you to seriously think about what the Fed or any central bank can actually do, what the limits of what it can do are, and what truly drives markets. I hope you found the session useful, and I thank you very much for listening.